Hello students, welcome to iExam B. So in continuation of our revision series for RBI Grade B Phase 2 2022, the topic for today's discussion is bond market and forex market. I am Shikha Malhotra, finance faculty at iExam B. I have more than 9 years of working experience with State Bank of India and more than 2 years of working experience as an academic professional. I am FRM certified and CFA level 2 passed. So coming back to today's topic, that is bond market or debt market. So before that, what are the bonds? So bonds are the long-term fixed income securities that are issued by the government and the corporations. So the coupon, maturity, principal and ownership are the features of a bond. So when an issuer issues a debt instrument or a bond to an investor, who is lender in this case, with the promise to make regular payments at fixed intervals of time during the tenure of a loan or the debt obligation. These regular payments are called coupon payments. They are generally done on half yearly basis, yearly, quarterly, as the case may be. Most of the time they are a half yearly basis. And maturity, the maturity of this debt obligation is also pre-decided. So the bond or the debt instrument is issued for a period of certain time period, like for 15 years, let's say, if it is issued. Then after the completion of 15 years, the issuer will repay the investor the principal amount for which this bond or the debt instrument was issued after 15 years, along with the regular coupon payments. So these are the main features of a bond. Ownership, the bond can be bearer bond and the registered bond. So bearer bonds are the bonds that are transferable by endorsement and delivery, and the payment is made to the person who is holding the bond at the present. And registered bonds are issued, registered in the name of a specific person or an entity, and payments are made directly to them. So debt market in India consists of mainly two categories. First is the government securities market and the corporate bond market. So government securities market is like the securities are issued by the government, central government and the state, central government and the state government, and various kinds of securities are issued. So government security is basically a tradable instrument issued by central or state government, and it acknowledges the debt obligation of a government. So whenever the government is in the need of the borrowing for meeting its budgetary requirements or fiscal requirements, then it will issue securities and get money in return. So those securities can be of different nature in terms of maturities, like T-bills, which having a maturity of less than 1 year, or government can also issue bonds or dated securities where the maturity period is more than 1 year. So in India, central government issues both T-bills and bonds or dated securities, but state government issues dated securities in the form of state development loans. And dated government securities are longer term securities, and they carry a fixed payment on the face value, which is payable at regular time periods, and the tenure of these dated securities can last up to 30 years. So there is a corporate bond market that also we will discuss along how we proceed with the whole thing. And before that, I want to discuss with you the structure of debt market in India. So we started with the this market segment of government securities, wherein it is a sovereign issuer. The issuers are central and state government, and the instruments that they deal in are treasury bills, bonds, or dated securities. Similarly, other than government, that is central government or state government, the market segment is of public sector units, and the issuers are government agencies, public sector owned units, commercial banks, public sector banks, and financial institutions, and instruments are PSU bonds, commercial paper, and certificate of deposit. So similarly, private Private sector will include corporate entities, private sector banks, and the instruments are bonds, commercial paper, and certificate of deposit. So the issuers, according to the various segments, when they issue certain instruments, when they are in the need of funds or when they are in the need of borrowing, they issue instruments, these specified instruments, to investors, that they will make a fixed income payments on these kind of investments. So according to the needs and requirements, these investors will buy and invest in this instrument. So who are the investors? Who are the investors in this case? They are banks, pension funds, foreign portfolio investors, mutual funds, provident funds, insurance companies, and individuals. So banks can be issuers also, and they can be investors also, right? Because in the case when the central government and the state governments are issuing the securities, banks will make investments in these government securities in order to meet their mandatory SLR requirement, that is statutory liquidity ratio requirements. So they make investments in these securities. So in that way they become investors. So broadly, these market segments are regulated by RBI, SEBI, and Ministry of Corporate Affairs. RBI mainly regulates the market wherein the maturity period of the instruments traded are less than 1 year, that is money market. Money market is regulated by RBI, like commercial paper, certificate of deposits, etc. And the other securities which are listed, that are regulated by SEBI, that is Security Exchange Board of India, and other unlisted debt securities are regulated by MCA. So the instruments we will broadly understand. We started with government securities, that there are different government securities that are issued by both central government and state government, and even treasury bills are issued by the central government in different maturity periods of 91 days, 180 days, 364 days, less than 1 year they are issued. Other than that, there are commercial papers. Commercial papers are the unsecured, negotiable, promissory instruments which are issued by corporate entities. Which are highly rated in order to avail short-term finance from market for meeting their working capital requirements. So instead of going to the banks, they go to the market in order to avail this short-term finance, which can be of duration of 7 days to 1 year. These papers can be issued for a duration of 7 days to 1 year, and this is regulated by RBI, and prior permission of RBI is required before issuance of these commercial papers. This issuance is beneficial both for the issuer as well as the investors. Investors can get higher returns by making investments in these commercial papers, and these papers are rated by reputed rating agencies, and the corporations are also rated. So in a way, it provides security to the investors, and these are also traded in secondary market, so it provides liquidity in the market. So this is beneficial both for the issuer as well as the investor. And also, instead of going to the banks, commercial papers can be issued by these corporate entities, so that they can avail finance quickly from the market by issuing these papers. So that way it benefits them. So similarly, certificate of deposits are also short-term usance promissory notes which are issued by the banks. It includes commercial banks, regional rural banks, and small finance banks. Earlier only scheduled commercial banks were included, but these were excluded. Now RBI has included this also to expand the money market, and particularly the market for certificate of deposits. They can be issued, and that also a period of 7 days to 1 year. and also they can be issued by these banks for a shorter period of time only. And then other is RBI Retail Direct Scheme. RBI Retail Direct Scheme is one of its kind, which was inaugurated by our Prime Minister in November 21 in order to include retail investors in the government securities market. So they, with this scheme, these retail investors can invest directly in government securities. They can actually hold a retail direct guild account with RBI, and then they can make a purchase. They can make investments in government securities through non-competitive bidding, and they can also trade that in secondary market. So in a way, this is to expand the horizon of government security market to include more type of investors, right? So that is the way through retail direct scheme. Other is state development loans. State development loans, as we were talking, they are dated securities that are issued by the state governments. RBI actually acts as a facilitator and issues on the state government behalf, and in order to meet the budgetary requirements of the states, these securities are issued, and the investors are commercial banks, mutual funds, insurance companies, and foreign portfolio investors. Even foreign portfolio investors are allowed to make an investment in this, and that is up to 2% of outstanding SDL in the market they are allowed. So repayments, whatever the borrowings are obtained through issuance of these securities by state, the repayments of these borrowings are made through the allocations made by the center to the states. And banks also make investments in these securities to meet their SLR requirements, right? And as there is no default risk or credit risk involved in these securities, so they are the safe investments. And the interest rates will vary as per the fiscal position of the state, but still interest rate is higher than the central government securities. Banks have a privilege, they have an opportunity to make an investment in these securities. They can meet the SLR requirements also and can earn higher rate of interest, higher than central government securities. Similarly, there are also long-term instruments which are there in the debt market, which are of longer duration, more than a year, 3 to 5 years, 7 years, 10 years, 30 years. So there are various kinds of instruments available. And there is one more categorization, that is zero coupon bond. Zero coupon bond, as the name suggests, there is no coupon payment made during the tenure of the loan or the debt obligation. So these are issued at discount and repayable at maturity at a face value. So the difference between the two values, that is discounted value and the face value, is called zero coupon bond. So coming back to the corporate bond market that we were talking about. So corporate bond market is a market wherein the security is issued by a corporation and sold to investors. So the backing for this type of the bond is usually the payment ability of the company, and which is typically the money to be earned from future projects or operations. So corporate bonds, they have a backing of the how the company operates and how its projects and operations go in future, how much money it is able to garner from those projects. So backing of those corporations, like in a government security we were talking, there is a backing of government, so they are more secured in nature, right? But in case of corporation, that is, there is kind of an uncertainty involved, so they are more riskier as compared to the government bonds, right? So as they are riskier than government bonds, the interest rates on these corporate bonds will also be higher, because if anyone wants to take that risk, if anyone is ready or willing to take the risk, that person or entity will definitely demand a higher rate of return, right? So as to compensate for that risk. And moreover, this corporate bond interest rates or yields, as we call, they are benchmarked against government bond yields only, and they are always higher than that, right? And their kind of spread is added from this government bond yields, so as to compensate for the kind of specified risk involved. So over and above that, they are charged, their interest rate is charged. And the major issuers of corporate bond in India are private sector companies, PSUs, financial institutions, and small and medium companies which try to raise funds from the market in order to meet their business needs. But the corporate bond market in India is not much developed. So there are several reasons for that. First is like equity market. This market is also categorized as primary market and secondary market. So there is an option of listing the securities and offering them to the public. But instead, the companies resort to private placement. They issue to specific class of investors because they find it less cumbersome in terms of documentation and less expensive, right? So it is convenient for them, but that makes things different in terms of other perspective, because it leads to lack of transparency and information in the market, which makes the market of this corporate bond market more illiquid, because there is no trading happening, right? In the secondary market there is no liquidity, and this is more riskier, right? First of all, there is no public information, because whenever the IPOs and everything comes, there's lot of information that is made known to the public, but in this case it does not happen. So that's why this market becomes more illiquid, riskier, and less attractive to investors. So that is also one of the reason. And other reason is that investor base is very limited, because as it is dominated by certain class of institutional investors like HNIs, insurance companies, and other institutional investors. So they dominate this market, but these players, they actually hold this securities till maturity. They do not trade in the secondary market. So that's why there is a kind of, this market remains underdeveloped, right? And other reason is preference for government securities. So government securities, as it is known that they are secured investments, so there is preference for government securities by investors as well as by a kind of banks also, because in order to meet their mandatory requirements. So government securities market is bigger than industrial debt market in our country. So that's why the more investments by these government entities and other government securities crowds out the private investment. So that's why that also is a reason that corporate bond market in India is not much developed. And other reason also, which is not a primary reason, but can be a secondary or one of the reasons that this market is not developed. This is the lack of development of associated derivative market like CDS and interest rate futures. So CDS is credit default swap. CDS is credit default swap. So this market is also not well developed, because what happens is that when an investor invests in any debt instrument, and if he has an option to buy the CDS on that underlying debt obligation, in case of CDS, the CDS seller promises that if in return of a payment of certain fee, that if the debt obligation is not the repayment for the same is not made, then he will make good the loss to the CDS buyer. So that ways, an investor who has made investment in debt instrument, if he also buys the CDS, and then with an insurance that if the default happens from the company's side, then he will not be at loss, because he has entered into that CDS arrangement. So that ways it works. So that kind of market, that kind of hedging market also is not much developed in India, as but government has taken various measures to develop the same lately. But still, that is one of the secondary reasons of corporate bond market not being much developed in India. So now coming back to the thing that bond yields and bond, how they behave in the market and what is their significance. So bond yields, as we say, the relation between the bond yields and bond price. So the relation between bonds yield is a return on investment that an investor has made in a bond. So that is called a yield. That is a definition of a yield. Is a return an investor gets on the bond, right, or on a particular government security. So this is called yield. So the relation between the bond yields and bond price is kind of inverse relationship. So when bond yields are rising, bond prices go down, right? So this is kind of inverse relationship between them. So what happens is that when investors who have made investments in bonds, when the bond yields are rising, right, so then they will start selling the bonds, that because they will have existing bonds on which they are not getting a higher yield. So then when there will be lot of selling happening in the market, then there will lot supply in the market that will push the price down. So how this market actually works, like in a theoretical way, right? So nowadays we are seeing that bond yields have been rising. Bond yields, here we are talking about government bond, and that is a longer duration bond, that is 10-year government bond yields have been rising, right? More than 7.5% they are as of now, and they are rising amid high inflation and plans for policy normalization, because bond yields are a kind of barometer for an economy. They have a direct implication on the lending rates by the banks as well. So as the inflation is rising, there is no point in keeping the interest rates low. So the bond holders are demanding higher interest rates so as to compensate for that inflations. So that's why when the inflation is rising, these bond yields are rising. And also when the government during the pandemic, COVID-19 period, when the RBI was doing the policy easing programs wherein it was injecting liquidity into the system so as to reduce the yields, so as to reduce the bond yields in the market, so that interest rates, lending rates offered by the banks also become lower, so that loans are offered to the public and investments become higher in order to increase the aggregate demand. This kind of thing was working. Now RBI does not have an accommodative stance anymore. It will not induce liquidity into the system, as already there is lot of liquidity in the system. It is on the path of normalizing those policies. So that's way, if the RBI also stops intervening in the market, so that way also the panic strikes in the market and the bond yields keep on rising, though investors demand more yields on their investments. So as government bond yields are we talking about that they are rising, so with regard to that, as I told you, that corporate bond yields are also kind of benchmark with government bond yields, and they are much higher than government bond yields. So that's why they are also rising. And the rise in the yield means markets have already factored in worst of the rate movements. As if we say that policy rate that is changed by RBI, that is 4.9% as of now, but the bond yields are more than 7%, more than 7%. So that means the markets have already factored in the worst of the rate movements, because the market makers are thinking that like market participants are thinking that interest rates would go up to 6% or something by this year or something, or in the near future. So already they have factored in the most worst of the circumstances. So that's why they're already bond yields are already showing 7% and more rates at the present moments. So that's why because of the current scenario this is done. And bond yields are basically the major factors that affect the yield is the monetary policy of RBI, because of the recent monetary policy committee announcements in changing the raising the interest rates, the repo rates and all, that is factored in the bond yield, and that's why it is showing. and also the course of interest rates, the fiscal position of the government, the fiscal position, that how much borrowing programs the government will undertake in the coming future, that also affects the bond yields program, bond yields movements, and the global markets, global financial markets, because the in the Fed, when the Federal Reserve raised the rates, even bond yields are rising across the globe as of now. So the bond yields in any country which are open economies, they are also affected by the global factors, global financial markets, and of course the inflation, right? So in order to factor in all these kinds of variables, the bond yields have been rising. So how rising bond yields impact bond investors and equity investors? So as I told, that bond investors, existing investors in debt funds, because when bond yields rise, then bond prices go down. So that bond prices go down, that is a capital loss to these investors. So that way it is a loss to these investors in terms of that, when the bond yields rise, capital loss to these investors. Similarly, for equity investors, it is kind of an inverse relation also when bond yield rise, because for the companies, cost of funds will go up, because as the yields are rising, they will not be able to avail the finance at a convenient rates. So as the fund cost of funding is on the rise, they will not be, the cost of funding will rise, and that will impact their earnings. So that will impact their credentials in terms of earning per share. So that has an impact on the valuation. So that's way it affects the equity investors also. And when the bond yields are rising, there will be an outflow from the equity investments to the bond investments, because the money will flow towards the less risky debt instruments investments. So that way it will affect the overall equity market as well. So now coming back to the forex market, forex market also consists of dealing in buying, selling, and exchange of foreign currencies basically. So it is called FX market, forex market, currency market, as the case may be, right? It is a market with a higher trading volume. It's a 24 by 7 market with lot of trading happening, and basically the purpose of all this buying, selling, and exchange for trading purpose, right, and for investment purpose, and also for speculation purpose, right? Some people speculate and then they earn money, and hedging also, right? So Indian foreign exchange market is a decentralized multiple dealership market comprising of two segments, that is spot and derivative markets. So spot markets are the markets wherein the transactions between the parties are happening at the prevailing rate of the currency. Whatever the foreign currency rates are there, that prevailing rate only the transactions are happening, and the settlement period will be like T+2 settlement period will be there, and all these transactions will happen. And the derivative transactions are there, which are happening at the later date. So in that even the currency risk will be involved. So what are the sources of foreign flows, as we are talking about foreign markets? So what are the sources of foreign inflows? That is, first is your export proceeds, right? Export proceeds in the current account from the invisibles, right? And also the foreign flows investments from FPIs and from FDIs, all these investments, and then your NRI deposits, and also external commercial borrowing. All these are foreign inflows. Similarly, outflows are also the imports which are happening, then outflows of foreign investments, and then redemption of NRI deposits, and all these are outflows, right? So derivative markets also, there are various options in terms of forwards, options, swaps, and forwards can be of maturity of 1 year, but as there is a lot of uncertainty involved, mainly forwards run for 3 to 6 months also, and options can be of various types like cross currency options, foreign currency rupee options, swaps also, cross currency swaps are also available. So who are the players in the foreign exchange market in India? Authorized dealers, mainly banks, brokers or intermediaries, customers or corporates. Basically, this segment is in bulk in foreign exchange market in India, and even now authorized dealers also. So earlier this market was dominated by brokers or intermediaries, but now ADs have taken the place. So there are several categories of authorized dealers also as per the act. So category 1, category 2 and category 3. Category 1 mainly consists of the banks, the scheduled commercial banks and public sector, private sector, and even foreign banks operating in India. And then category 2 will have the full-fledged money changers that they have the authorization to deal in the buying and selling of the currencies, and also some specified cooperative and regional rural banks. At category 3 also some specified banks like Exim Bank are also in category 3. And classification of foreign investments are basically in a two-way we can do, that is foreign direct investment and foreign portfolio investments. Like foreign investments can be through the approval route or automatic route, where the automatic route there is no approval required beforehand, but in other one there is an approval required. So yeah, FDI and FPI. FDI is a longer term like base of permanent investment, foreign direct investment, and foreign portfolio investment is basically a temporary kind of investments, more volatile in nature. So it depends on the kind of percentage of investments made. Like if 10% of or more of the post issue paid up capital is made, that is called FDI, and if it is less than that, that is FPI. So that is foreign portfolio investment. So these investments are very very important for our country, as because for every emerging, be not emerging, any country, foreign investments are more important in order to undertake more investment opportunities and spending on infrastructure. We need additional investments through foreign flows. So that's why foreign portfolio investments, in order to attract these foreign portfolio investors, they have been allowed to make investments in government securities also, state development loans, and even corporate bonds. They have been allowed. I think government securities, they are allowed up to 6% of outstanding, and SDL it is 2%, and corporate bond it is 15%. Right, earlier it was 9%. So similarly, for other framework also have been established for investment by FPIs. So that is, one is called this is fully accessible route. So in the union budget of 2021, the government had allowed the non-residents investors, including foreign portfolio investors, to fully invest in specified government securities without any restrictions. Without any restriction means, as it is applicable to domestic investors, they were allowed to make an investment. So FBI created this particular window that is called fully accessible route window for these investments for the securities, those specified securities, those designated securities issued by Government of India. So these specified securities, once they were designated, they were eligible for investments under the same window till the maturity period. Right. So similarly, there is also voluntary retention route that was introduced in 2019. It is also a special channel of investment which is available to FPIs to make investments in debt market in India over and above their normal route, right? So this is a special channel of investment which is applicable for foreign portfolio investors. And with that, what is that flexibility is provided to them, that these investments can be made without any regulations, without any restrictive regulations like macroprudential regulations or any other regulatory requirements they need not fulfill to make an investment under this route. But as FPIs are more volatile in nature, so in order to attract more long-term and more stable kind of investments, this route was established with the condition that they have to be retained for a period of 3 years. For a period of 3 years, and minimum 75% of allocated amount to be maintained in India by FPIs for this period. And there are several categories under this VRR for which the investment can be made, that is in government securities, corporate bond, and commercial paper, and hybrid form also, government securities and corporate debt they can make an investment in. Right. So other part which is important in the foreign exchange market is the external commercial borrowing. So external commercial borrowings are the commercial loans which are raised by the Indian resident entities who are eligible to do that from non-resident entities which are recognized as well, right? And they have to conform to certain kind of guidelines. So external commercial borrowing refers to commercial loans raised by Indian company from foreign lenders, and they can be raised in Indian rupees or any convertible currency. So this ECB framework was also revised in 2019, and which includes loans, bank loans, and floating or fixed rate notes or bonds, debentures, trade credits, foreign currency convertible bonds, and foreign currency exchangeable bonds, financial lease, and plain vanilla rupee denominated bonds issued overseas. All these are included in the kind of, and moreover this is for foreign currency denominated external commercial borrowing, and for external commercial this one for rupee denominated also these things were included, all these things were included, right? So and similarly there are eligible borrowers also, that who are the eligible borrowers. So in case of foreign currency denominated external commercial borrowing, all the entities who are eligible to receive FDIs, they are eligible to raise external commercial borrowing from abroad. Further, apart from this, port trusts of India and units which are there in special economic zone, they are also eligible, and SIDBI and Exim Bank are also eligible for this as an eligible borrower, right? And in case of rupee denominated ECB, all registered entities engaged in basically microfinance and other non-profit based companies also eligible as are eligible borrowers. Similarly, there are other parameters which need to be followed to avail the external commercial borrowing, like minimum maturity period also has to be there, and permitted deployment of funds, where the funds can be deployed, and use of funds, and which categories are non-permitted. So all these are the part of external commercial borrowing guidelines. So that's it for bond market and forex market. Broadly, I've covered almost everything. Then other parts of things also can be, you can please see and in the notes also. So apart from that, we'll just discuss one MCQ here. So debt obligation in the form of bonds issued by banks and used primarily to finance a pool of loans. The loans making up a pool traditionally stay on the issuing bank's balance sheet. These type of debt obligation and bonds, if issued, they are called covered bonds. So they are different from asset-backed securities, because in asset-backed securities, the securities that are issued against the security of those pool of loans, those pool of loans are offloaded from the balance sheets of the bank, and then they are issued by the special purpose vehicle, and then they are like the investors who have made investments in these asset backed securities, they do not have any recourse available to the originator, that is the bank, right? But in case of covered bonds, these bonds are covered by not only by they have a recourse available not only to the issuer but also to the covered pool of loans. So that is double recourse is available in case of covered loans. So that's why they differ from asset backed securities, and these covered pool of loans can be mortgage loans, vehicle loans, infrastructure loans, or anything like that. So that is for today. All the best for your preparation. Thank you. And before going, just don't forget to subscribe to iExamB channel, and don't forget to press the bell icon. That's it for today. Thank you.